Right. Yeah, so what up guys? How we doing? Hoping we're having a very lovely day and so welcome back. Yeah, after the long break, welcome back. Our vacation is over now, so it's time to get back to work like this. So let me do a quick recap about the VIX strategy before I talk about what I'm supposed to talk about today. We've been doing some tutorials and some teachings of how the VIX strategy actually really works. And I said in the beginning, we're focusing on 5 major things. We're focusing on 5 major things. Those are going to be the core things we're going to learn. And the only things that the VIX strategy comprises of, you understand? Yeah. Let me digress a little bit. They say there is no strategy that is 100% win rate. That's very true, I agree. The VIX strategy does not give you 100% win rate, but it gives you a very high chances of and gives you a whole lot of opportunities if you know how to maximize it very well. And regardless how perfect your strategy is, all strategy needs improvements depending on the cycle of the market. You understand? Yeah, so back to what I was saying, I was like, yeah, there are 5 things we're going to focus on. Number 1, we'll focus on market structure, which I've dealt with. I will still be dealing with when I start teaching about entries and we start doing live sessions. Market structure, order blocks, fair value gaps, Fibonacci, and liquidity. I'll come again. Market structure, order blocks, fair value gaps, Fibonacci, and liquidity. Remember I said fair value gaps and order blocks are point of interest. The rest are just more confluence to back up everything we're talking about. All right. If you go through the VIX strategy, the previous videos, you'll see when I'm talking about the VIX strategy and you go through all those ones and master all those ones first. I arrange them sequentially so you know which one to watch first. You understand? Yeah. So today I'm going to be talking about Fibonacci. This is going to be a short video. Like what I'm going to explain is very short. So it might just be more admonishments that might make the video a little bit long, but this Fibonacci is very short. It's very easy to understand, right? So we'll go straight to the business. Yeah, let's go straight to the business. So Fibonacci normally is an indicator. Fibonacci is an indicator. If you've been watching both in the WhatsApp group and on YouTube, if you've been watching this VIX strategy very well, you will notice I don't use indicators on my charts. I don't use MAs, I don't use RSI. I'm not saying these things are bad, but I just trade pure price actions. Indicators are the lag to me. Yeah, they only tell you what price has already done. You understand? The lag. Yeah, so that's why when I first started, I started with indicator, you understand? So that's why I said I should be trading price action, and I think that one resonates well with me. All right, it resonates well with me. So Fibonacci is a part of indicator, but it's way different, you understand? When I'm talking about Fibonacci now, I'm talking about Fibonacci retracement too. I'm talking about the Fibonacci retracements. They have Fibonacci, the one that comes like a trend line. They have the Fibonacci, but Fibonacci retracement, that's the most popular one, and that's the one I'm talking about. When you see Fibonacci retracement, this is what it looks like. This is what it looks like. You will see 0.0. Fibonacci has different types of different levels: 50.0, 0.0, 61.8, 100. You can even erase the numbers and put the exact numbers you want, which I'll be going to chat now to explain. But Fibonacci retracement 2 is just an added confluence for you to know where the market would most likely retrace off from or bounce off from. That's what we use the Fibonacci retracement tool for. If you look at my left-hand side now, okay, sorry, let me bring out this one. If you look at my left-hand side now, you will see this is a sorry, I made a mistake in the labeling of this chart. Sorry, this is a bearish market, sorry, and this is a bullish market. I made a mistake. I didn't see it before now. So just forgive that mistake. So this is a bearish market, all right? So in a bearish market, we have a lower lows and the lower highs. This is the lower lows, this is the lower high, lower lows, lower high, lower lows, all right? And in the bullish market, not bearish now. Okay, let me just do this away. Just do this away. And in the bullish markets now, we have the higher highs and the higher lows, the higher highs, the higher lows, and the higher highs. So You know, we say in a bearish market, we buy in. In a bearish market we sell, and in a bullish market we buy. So in a bearish market like this, we're looking to sell at the premium level, and in a bullish market we're looking to buy at the discount level. Like I said about premium and discount before, you want to buy a product or whatever object when it is at a discount price. It's more affordable to buy at the discount price. When the price is lower, that's when you buy. And you want to sell something when an object, whatever it wants to be, an asset, when the thing is at its prime, when it's at its premium level, when people are rushing these assets, that's when you most likely want to sell, because it gives you more profit that way. That's just the definition of premium and discount. You understand? So Fibonacci tool just helps you understand premium and discount very well. When you're marking a Fibonacci tool, you draw your Fibonacci. Now, you mark them differently in a bullish market and in a bearish market. In a bearish market, now that's a selling market, a market that's going downward. If you want to mark your Fibonacci tool, you draw, this is your lower high now. You draw the Fibonacci from your lower high down. I know why I used to draw my Fibonacci out like this. I used to draw it so I used to draw it way to the right. So I'll be able to, I used to draw it way to the right to the future, so I'll be able to see what the market is playing very well. You understand? So you mark it from your lower high to your most recent lower low. You need to remember that the Fibonacci that price has not yet given you if it wants to break the lower high or it wants to continue rallying lower. You understand? And remember, you want to buy to premium. See something now, let me digress a little bit. Let me talk about premium and discount. In the Fibonacci, let's just make the Fibonacci line. Let's make the Fibonacci lines to be 3, which is the 0.0, the lowest part of the Fibonacci, the 50.0, which is exactly half of the Fibonacci, and the 100, which is the extreme of the Fibonacci. Not the extreme, actually. They still have other higher numbers, but for the VIX strategy now, 100 is being the extreme of your Fibonacci tool. Now, in a bearish market now, from the 50 downwards is your discount, and from the 50 to the 100 is your premium levels. So you want to be selling from anytime price gets to the 50.0 upward, not necessarily when it taps the 50.0 you sell, but anything upward. You look for other confirmations, but anything from the 50.0 up to the 100, you want to be selling. And anything when you want to buy anything from, how will I put this now? In a bullish market also, when you mark your Fibonacci, you also, in your discount level is going to be from your 50 to your 100. You understand? You want to be buying exactly when the Fibonacci enters into from your 50 to your 100. This level here, imagine this is your 1, 2, 3 levels. Anything below here is your discount. This is your discount. This is your discount. This is your premium. This is your premium. That's that about that. So let's go to the charts. Let me explain how I mark our Fibonacci tool. And when you're using Fibonacci tool, you have to go to the very high time frames, like the 1 hour, 4 hours, daily, weekly, to mark your Fibonacci. You don't just enter when the price gets to your Fibonacci. We look for other confluences like fair value gaps, other blocks more especially. Do you understand? Yeah. So let's go to the 4 hours, for instance. Let's go to the 4 hours, and okay. This is a bullish market. We have higher high, higher low, higher high, higher low, higher high. We'll come here to have a higher low, higher high, higher low, and thereabout. So let's mark our Fibonacci now. Remember, in a bullish market, you're marking from your higher high to your most recent higher low. You understand? So this is your Fibonacci tool. We're marking from here to here. You understand? Sorry? Well, sorry, we're marking exactly from here. Sorry, we're marking from your higher low. In a bullish market now, you're marking from your higher low to your most recent higher high. You understand? So you mark it like this to your most recent higher high. This is how we mark it. All right. You know why I marked. I hope you guys are jotting many things down. You know why I actually really put this is to 1.8 here, because it's a very important level in the Fibonacci tool, and this is how I work with this to 1.8. Anytime the market gets in between the level of 61.8 and 50.0, you see that line that's in between. Okay, let me mark it out. Let me mark it out. I'm sorry. Let me mark this out. Anytime the market gets to this level, in between your 61.8 and 50.0, let me just... Anytime the market gets to this level, I'm always very attentive, especially if there is an imbalance here or an order block. I'm always very careful to look for entries within that level there. You understand? Anytime the market gets to in between the 61.8 and the 50.0, depending if it's a bearish or bullish market. And if it gets here also, I'm always very attentive. And see what happened in this chart here. You mark from your, higher low to your higher high. This is your higher high here. Remember that the market has, why I just extended this on to the future? Remember that the market has not given you all these guys yet. This is where the market probably is. You understand? You're waiting for the market to retest so you can buy. You understand? That is the way the VIX strategy works. You wait for a retest, then you buy. Like making sure you're following the trend, right? So now let's mark out that our 50.0 and 61.8, that area there. That area there, look at the area there. This is the area, 50.0 and 61.8. And guess what happened? Guess what happened? Immediately the market came into that region. So what happened? It just rejected off it. Hope you guys are understanding now. The 50.0 and 61.8 is a very important region in the Fibonacci. And you know why I would not take this trade? Because there was no another confluence there. There was no order block or fair value gap I would like as a point of reference in this place. You understand? Probably if I scale lower and start talking about entries, in the 1 hour, there might just be some kind of order block laying in this place for me to use. You understand? But I'm not talking about entries now. I'm talking about Fibonacci. All right, let's remove this Fibonacci. Let's give another example again. This is, and remember, from the 50.0 to the 100, this is your discount. That's what you're looking to sell. But this place, more importantly, is a very important region. So this is your, higher low, higher high, right? So we just bring that Fibonacci there. Higher low, this is your higher high. And see what happened again. Exactly that same level again. That's where the market entered. That same level again. See, that same level, your 50.0 and 61.8. That same area. That's where the market bounced off from again. You see, we will have caught this one. Why? Because there was an order block here for us to use as a reference. You understand? And we'll have caught this trade. Let's look for a bearish market. Let's use a bearish market example. All right. And remember once again that if the market did not come to this discount level, we don't buy, and the market does not come to a premium level, we don't sell. All right. So let's look for a good normal bearish market. All right. Okay. It is a bearish market. All right. We have, it's kind of tiny now. Let me zoom out a little bit. Okay. We have your lower high, lower low, lower high, lower low, and thereabout. Let's bring our Fibonacci to from your lower high. Remember, this is your lower high, this is your lower low, all right? You draw it there like that. You see what happened if you're drawing your Fibonacci in a bullish market, you draw it from your higher low to your higher high. But if you're drawing it in a bearish market, you draw it from your lower high to your lower low. You understand? So, this, see, you have to see now there's a whole imbalance in this place here now. See what happened? The market retraced. Remember, you need to understand when you're marking your Fibonacci, the market has not done all this one yet. The market just gave you your lower low, and your lower high. You're waiting for it to retrace so you can enter a sell, right? The market actually immediately just tapped the 50.0. It retraced immediately. It didn't enter this level here. It didn't enter this level here, but it's still a good trade though, but I wouldn't enter because there was the imbalance here. Maybe when I go, scale lower, there might be some kind of reference. But see what happened. This is how the Fibonacci works. We won't enter this trade because it didn't enter fully into the 61 and 50.0 or the discount level. There are some times that the market will scale low and we go upper than this before retracing. It will come to this level here. But as long as it's still in a premium level for itself, we look for confirmation. Why? Because there's an order block here that the market might just want to tap into this order block before scaling lower. It might not just, this is just an added confluence. This is to 1.8 and 50.0. All right. That's just basically that about Fibonacci. You see what I just explained now? If you watch this video once and you don't know anything about Fibonacci before, you would not understand. I'm being very honest with you. Unless you calm down to listen to everything I'm saying word by word, you understand. That's when you will get the whole concept. You have to go to your charts, draw your Fibonacci in a higher time frame, then go lower to look for interest. I don't want this video to be too long. It has extended the period I want it to extend. But go to your charts. The draw of Fibonacci, come to my DM, bamboozle me with questions. I'm always down to answer your questions. As long as you are inside the VIX community, I will answer your questions. Like, you're not disturbing. I love those kind of questions where you really want to learn. Me myself, there are mentors I disturb when I want to learn. Like, seriously, I go to their DM. I don't understand what's happening here. I'm not Mr. Know-all. Like, seriously. So that's how it works. All right, so that's that about that, farms. That's that about Fibonacci. Let's not overcomplicate Fibonacci. It's a very easy thing. Like, seriously, very easy thing to use. You understand? As an added confluence, don't just enter a trade just because your Fibonacci is in that key level of 61.8 and 50.0. All right. After the video, anybody that watched this video, let me know this is how I know if you watched the video now. That's why I'm going to give this assignment in the ending of this video. This is the assignment. After watching this video, draw a bullish Fibonacci and a bearish Fibonacci for me. You understand? See how it respects your 61.8 and 50.0 and send it in my DM. There is a gift waiting. I'm honest now, there's a gift waiting. If you watch this video and you send it to my DM, I know you actually really watch this video and I'll send you a gift. Like, seriously. So that's that about that, farms. Cheers and